Good afternoon, everybody. Welcome to our panel. Full group here, so I think it's going to be an interesting one. My name is Christophe de Celle. I'm the Chief Commercial Officer at Selini Capital. We are a global investment and trading firm in crypto, active across market making, venture, and OTC. Maybe we'll just kick off with some quick introductions from everybody, very quick, and then we can get into things. John, do you want to kick off?
John D'Agostino, Head of Strategy for Coinbase Institutional.
Melvin, CEO of QCP. We are Asia's leading digital asset partner.
Christian Davies, the Global Head of Distribution and Innovation for Relm Insurance. We're the largest specialty insurance company specializing in insuring, well, crypto companies and other emerging technologies.
Good afternoon. My name is Nicolas Cary. I'm the co-founder and vice chairman of blockchain.com.
Hi, everyone. Evgeny Gaevoy, founder and CEO of Wintermute, market maker in crypto, active across DeFi, CeFi, and OTC.
All right, thanks, guys. All right, so beyond spot and futures, we're going to sort of dive into the more institutional side of the product offering in the space. But I think it's maybe helpful to define what we mean by institution in crypto, because at times it's a little bit of a broad definition. Maybe Nick, you have some thoughts there to kick off? Do you want to kick off, Evgeny?
Yeah, I mean, it's a weird one. Like, I think most people usually assume banks or hedge funds and like those kind of counterparties ultimately, but it's much broader than that, because we see like more traditional venture funds, we see family offices. Basically, it's anything which is corporate, I guess, counts as institution, at least for us. And yeah, how to get different types of them, like on-chain, auto-trade instruments that we trade, like that really depends on the type of this counterparty, type of this corporation, and it's, yeah, I guess that's what we'll cover today.
I oddly have a strong opinion about this. It's a weird thing to have a strong opinion about. I know, but this is like a hill I'll die on. I think about them in terms of, very simply, fiduciary versus non-fiduciary owners. So I think if you think about sort of the typical institutional investor that is managing on behalf of others versus managing an asset owner, like insurance pools, sovereign wealth funds, et cetera, I think that's an important distinction, because they think about risk in different ways. They think about duration in different ways. Their goals and intent of investing are fundamentally different. They tend to have longer cadences of reporting requirements, if at all. And so when you think about their exposure to convexity trades and derivatives instruments, that to me has been historically, in my experience, my background's in commodity derivatives, that's been the most important distinction about who they are, what they're looking for, and what products to offer.
Yeah, I think I want to add to what John said. It's really about a mindset of how they think about things. I think if you're saying you're an institution, then you've got to have processes that create accountability and transparency. And I think that's really more of a spiritual thing and conceptual thing, rather than a labeling.
There are even other actors that I think are kind of interesting. So at blockchain.com, we founded the firm in 2011. So the reason I'm up here looking like a central banker today is because as I've come up the fluency curve in our own industry, I've realized you do have to show up. And some of the earliest adopters in crypto are now themselves financial institutions. They have rapidly come up the wealth curve, and they have completely different requirements than they did 5-10 years ago. So you've got sort of these very wealthy crypto natives, you have family offices, you've got hedge funds, crypto hedge funds, you have traditional financial services firms, and increasingly you have publicly traded companies that are looking to diversify their treasuries. So all these actors are participating as institutions in crypto today, and they are a big piece of the daily volumes, they're a big piece of new sources of capital to the industry, but they all have, like you said, different mentalities. Some of them are looking for very high-risk situations, and others are looking for very risk-mitigated ones. And interestingly, it allows the actors in our space to come up with very unique product offerings and client solutions. And I'm very bullish on this space for us over the next 10 years, especially as so many more actors are basically looking to diversify out of their current situation and looking for ways to basically protect their wealth.
I think from an insurance perspective, we see it as people that have a potential liability to another counterparty, right? Kind of reminiscent of what you were saying, right? People are looking for some kind of return or some type of investment. Usually liability associated with it. If it goes wrong, someone's going to sue you. So that's the way that we look at it, what is an institution.
And if we look at things maybe more through the lens of products, how are these institutions using crypto products? So spot and futures, kind of sort of plain vanilla. But if we dive more into, for example, options, how are they thinking about trading these instruments? Maybe Melvin, you want to kick off with that one?
Yeah, I think there are two ways of looking at it, right? So, I mean, the institutions typically like to use the options to get a convexity on it. But we've also seen quite a fair bit of hedging coming through. So when we're thinking about how institutions think about risk and how they generate returns, is really about what is the purpose they're trying to achieve, what kind of risk return, risk rewards they're coming through. So from over the last 7-8 years that we've been involved in options, we've seen people going from simple, put call selling, and now they're putting on kind of spread trades and convexity trades. So definitely we're seeing a maturity when it comes to risk profile and the way they think about risk.
Yeah, so going back to my bifurcation between asset owners and fiduciary capital, Melvin, I think you're right. So if I'm an asset owner, if I have a long duration position, I'm looking at basically over time being long vol. And I want to reduce my theta, my decay. I want to just make the cost of that less over time. But I'm less concerned about that theta than, say, like a fiduciary trader, because I'm not worried about reporting that loss on a quarterly or annual basis on a typical hedge fund. So, but it's very, very important to make that attractive, because without that institutional underpinning that's just traditionally long vol, you then kind of the market gets skewed, and so you maybe have a deep market, the options are trading like water, everything seems great, but you don't have a broad market. You don't have commodities. You've got this luxury of having like natural buyers and sellers that have to enter the market every year, whether it's because they're Sara Lee Corporation is switching over to natural gas, and we know they're going to come in every year, or the California EPA requirements kick in the summer, and we know that like this type of fuel oil. So you have this wonderful natural buyer underpinning, which you kind of don't have in crypto. The miners to some degree provide it. Increasingly, the ETFs are providing it. But it's really, really important to cater to that group, because without it, you can have liquidity gaps on the option side for everyone else playing on the short vol side, or that can be very, very damaging.
Just staying on the topic of the balance in the market, okay, we're talking about institutions today, but the retail component is an important piece of the puzzle. In crypto, we have this sort of 100x perp degen culture. What do you think it's going to take to see like a real pickup when it comes to options?
Yeah, I guess my prediction would be we'll be stuck with this 100x products for a while. It's basically the implied vol, basically the characteristics of this volatility is just too expensive for people. On one hand, it's just too expensive for crypto natives to gamble in options instead of perps. On the other hand, they're just used to perps by now. So my prediction would be that instead of options, you might see further gamification of it, like binaries, will Bitcoin trade above 150K, stuff like that. So I think it's more likely we'll go into that direction, which will be options, but not like institutions expect them to look like.
I might take a slightly different view on that. I think the era of 100x feature sets are probably not going to last forever. Every few years, retail users get absolutely crushed using these types of products, and they're very expensive lessons for especially young, adrenaline-fueled young people. And so I think there are going to be some painful lessons that continue to be learned with those types of products and services, but there's also a huge amount of liability running those types of systems. And so I'm a little negative on those, and I think a little bit more positive on options in general, which provide a much more consistent risk-adjusted approach to basically managing your exposure in these markets. But there's definitely a lot of people that still love to smash the button and risk everything and on a one-time turn. But at the end of the day, those people don't tend to have long-term life cycles in our space.
Yeah, but I mean, they don't seem to learn as well. You essentially every 2 years they get, well, even more frequently now, they get crushed out, and yeah, every few months new retail is born and they keep doing the same mistakes.
We always ask the question around what kind of strategies people are putting in place, or what kind of features are on exchanges, etc. But the fact of the matter is the faster someone can lose money, the more likely is that they're going to sue you. So that little button that has 100x is obviously great for you guys, but just makes your insurance far more expensive?
I think we're into a very odd space when it comes to market psychology. I think Evgeny is right in the sense that what GameStop's done to the retail investing cycle and the way they've thought about it, putting alongside how inflation's really been eating away at savings and earnings. The retail investor tends to take on where the perpetual perps, what they generate and what the possibilities that create that. But that's also why, from an institutional standpoint, the fiduciary duty that you have in terms of safeguarding and ensuring that, you're making returns on a risk-adjusted basis. I think that's where we're going to see a break in the way the markets are going to think about investments and returns.
I gotta be honest, I agree with both Nicolas and Evgeny. I agree with Evgeny that and I'm on the institutional side, but on the retail side, I do think there's this insatiable, repeated appetite for risk, regardless of losses. But I'm going to put words in your mouth, Nicolas. I think it's maybe not the best thing for our industry if we satisfy that appetite too much. It might be that appetite gets satisfied around prediction markets, and that's how they represent that, because there seems to be a social agreement that those are more okay than maybe traditional financial institutions, and I'll lump Coinbase into a traditional financial institution, offering that to moms, pops, and 19-year-old or 21-year-olds. So maybe prediction markets are how those manifest.
There's definitely not been any slowdown of Reddit posts of someone on Wall Street Bets saying how they've YOLO'd 100x and lost all their money. That's not slowing down.
Right, but to Evgeny's point, there could be 100 of those, or 1,000 of those, or 10,000. But if there's one Reddit post of YOLOing and successfully YOLOing, right? We all buy lottery tickets because there's a reason they put that winner on the advertisement, right? So what we would advise our family members to do and what they will do are two very different things.
Because those people are not listening to us. Like they're probably not going to listen to this panel necessarily. They're going to listen to Coel on YouTube telling them for the next 100x target. That's it.
They might listen to get the message out there. Just moving up in complexity a little bit. So, like on the TradFi side, structured products, very common. Big business with private banks. Pension funds in Holland buying funky structures, etc. I still feel that in the crypto space, it's still early days, and I don't know if it's maybe potentially the distribution side of things that hasn't really been cracked, or maybe an understanding of the benefits of these products. Maybe Melvin, you can elaborate a little bit there.
Yeah, I would say that it's still quite a long journey, and I think a lot of people are still not comfortable with the volatility of the underlying. Every time you kind of see confidence building, then something like what happened on 10th of October just kind of creates that kind of concern. And when you talk about structured products, people are actually trying to get some certainty with regards to the underlying asset to make a view. And that's something that at this stage we are not, as an industry, has not been able to provide. That creates a suitability issue. And I think when we think about investors, suitability still remains one of the big issues that they need to be solved.
But would that high volatility allow for some nice headline yield figures, or?
Oh yeah, absolutely. But I think most are too captivated by the yield, and they're not thinking enough about what the risk is. And I think we need to come to a place where people understand, the risk and the rewards. A lot of them have been focused on the rewards in this current, scheme. But I think it's something that will come. I think education is something that's been quite present across. And I just think a bit more processes around, suitability is probably just the last bit for me.
I would also say that we just lack some basic plumbing in crypto as well. Like we don't have like a wide set of prime brokers who can basically take on counterparty risk, because volatility is that's one component, but like there is just such a big measure of counterparty risk in crypto. Like if somebody comes to do structured products with us or QCP or blockchain, like they just face they face a risk of losing the money on the structured product, but they also face a risk of one of us going out of business and basically effectively losing on trade or losing the collateral they hold with us, for example. And there is no good plumbing, there is no like prime brokers, there is no like, okay, there are some like third-party setups one can come up with, but they're just very inefficient and they inevitably lead to, well, us price invite effectively. So I think until we get to a level where TradFi is in terms of efficiency, capital efficiency as well, I don't think we'll see massive adoption of those products.
But how much business are you doing with people who could potentially go bankrupt, rapidly?
No, but I think it's a concern that we will go bankrupt or QCP will go bankrupt. And so like it is a concern for like wider range of institutional clients.
Yeah, I mean, structured product issuers want to be able to decompose the risk of that structured product and isolate it to very specific or almost no risk, right? The reason that my guy at Merrill Lynch calls me every other day with a new structured note on equities is Merrill has completely hedged out all of that. The term structure for, the whole point of this conversation, when is the term structure for options and futures in crypto going to be at the point where a big issuer could construct a massive 5-year straddle and hedge out 99% of their risk over the next 5 years? They can't do that right now. You can do that in commodities. You can do that in equities. You got to build the decomposable parts before you can mash it all together and kind of rob your client for like 6%. I just don't think we're even close to being there. Without, as Evgeny's point, that issuer has to take enormous dealer risk and warehouse all of that for a couple of years.
Someone did tell me 5 years ago that they had issued a VAR swap on Bitcoin. I'm not sure how they hedged that out, but
I've started getting them on Bitcoin.
that might be a marketing headline.
Yeah, because they got IBIT. I've started getting them on Bitcoin from Merrill Lynch, Bank of America. They've started offering those, but out 12 months, not 18, not 24. Yeah.
Staying on options and subject of options, there's been interesting developments on the exchange side recently. So obviously Coinbase purchasing Deribit. I think that's like a really interesting catalyst for the space. John, I'd be interested to see kind of your views on how you see things developing from a trading perspective, platform perspective, et cetera.
Yeah, I'll be brief. I'm monopolizing this conversation. It's going to be massive. I mean, again, go back to traditional markets. I mean, the OTC derivative to spot multiple in equities can be anywhere from 12 to 20, and commodities is 30 to 60. So we're not there yet in crypto. So I fully expect that derivatives market to absolutely dwarf the spot market over time. And Deribit's a monster, and we're really glad to work with them now and build that out.
Have you any views there on the sort of the liquidity development there on options?
I mean, we do see a lot more competition now. So traditionally we just had Deribit. Now we have CME with we have Solana, Ripple there as well. We have Bybit and Binance doing stuff as well. So there is a lot more going on in general. There is a pretty big fall in liquidity once you go past Bitcoin and Ethereum, and that definitely doesn't allow for more complex strategies, and you typically just go into this issue of counterparty risk right away, because it's much easier for us to do some bilateral things and to structure something on rather illiquid markets on those other exchanges.
Okay, thanks. I might be pushing the boundaries a little bit, but we haven't really talked about on-chain products. There are a few investment banks that have issued structured products on-chain, maybe more of a flex than a real product that's being used by people. But I'd be interested to kind of hear your thoughts on the on-chain opportunities for institutions today, if you think it's a viable route.
I would say the biggest issue with on-chain derivatives in general is just capital efficiency. Especially when it comes to options, it's as a market maker, you just cannot do it. Nobody came up with a proper way to do it. It's might be even not possible, or it's just still years away from coming up with something that works. So until we solve this capital efficiency, until market makers can write options without actually posting 100% collateral in the underlying, we're not going to go anywhere on chain.
I think just to touch on what Evgeny said, I think also the unwind of a credit event for an option is almost impossible on chain at this point. We've kind of looked at it and looked at the technology, but when you got to split the vol out from the deltas and stuff, I think it's not possible to achieve this on a smart contract. So I think in a very traditional credit event, the clearing members will basically split up the risk and auction it off. But in a smart contract, I don't think that's been quite thought through, and I think that makes it very hard for risk management.
So if there are degens in the audience, then it's blasphemous. You're saying a smart contract can't do everything? Really?
I think those institutions are currently dabbling. Obviously, I think those are very experimental initiatives. On the on-chain side, we recently launched a partnership with Ondo Finance to provide basically tokenized stocks to people in frontier and emerging markets. It's been extremely well adopted. It's a really interesting use case for people to basically gain access to American equities that otherwise never would have been able to do so. And so it's broadly accretive to our most important publicly traded companies in America to basically proliferate access to the American economy quickly and easily. And that's an on-chain use case that I'm really excited about. On the institutional side, I agree. Like, they're just light years behind on actually getting there, and also it's just a reflection of where we are in the market maturity. We would not have been having this type of conversation 4 years ago at all. So if you look at what has been achieved, I think it's important to understand that there's a very sort of fertile future for the next decade, and really it's partially driven by homogenization of regulation. Europe got there very early with a single sort of regulatory environment. The United States has caught up and leapfrogged in a lot of ways, and there are other jurisdictions like Dubai and Singapore that I think are finally really doing some interesting work to encourage and basically teleport capital and intellectual competency to their jurisdictions. And so it's a short way of saying that, like, the future is still bright in that department, but the risk tolerance in these old institutions we were talking about even before coming on stage, you've got generational challenges there, you've got regulatory ones. It will take time to flush through the system.
It's not necessarily a structured product or a derivative or a perp or anything, but we're a TradFi, right? But we have a fascinating license that we can actually build ILSs or insurance-linked securities entirely denominated in crypto. So when we talk to TradFis or institutions or DATs, etc., and they're looking for some kind of yield on stablecoin or Bitcoin, we have the ability to build a vehicle that they can put in, $5 million, $2 billion, $3 billion worth of crypto and earn potentially up to 20% yield on that from the underwriting profit of the underlying underwriting. It's a vehicle that's been around for decades and decades, and it's a very highly regulated vehicle as well. But we just have the ability to do that in crypto. Even that is still a very long conversation with people to say, oh, well, how does it work and what is this? The regulation foundations have been around for ages, and now just that we can do it with crypto, there's a lot of interest in that. But yeah, definitely not a perp. Talking about on-chain, you can bring that entirely on-chain because you don't need any rapid in and out movements because insurance contracts are typically 12 months long. Which is very anti-DeFi, very anti-degen, but you get good yield on it, I guess.
Maybe on the topic of insurance and portfolio protection, we really haven't touched much on risk management. I think in the early days of crypto, a lot of the liquid crypto funds would just have to reflex to sell their spot and move into stable coins. Maybe Melvin, you can elaborate a little bit more on some of the hedging strategies that are quite interesting that you've seen recently.
Yeah, I think the hedging strategies have largely been quite standard, but we've seen quite a lot of movement in terms of trying to find more liquidity for the hedging. I think, we've seen a lot of standard basis where you take the alts and hedge against the Bitcoin and ETH, but we've also seen quite a lot of hedges going outside of the typical asset class. So hypothetically today, if you think about you've got a Bitcoin position, your hedge, actually the cheapest hedge is probably an S&P option. And you just have to adjust your correlations to that. So we're seeing quite a bit of this. And because we are we've just come out of a bit of a liquidity crunch. You are seeing that there's a bit of mispricing and structural gaps. So from our perspective, this is what institutions are actually thinking about, right? You're thinking about hedging your risk across asset, but studying the correlations and managing that. We see that kind of sophistication starting to show. But back down to risk management, I think one of the things that we still can be better is about being more articulate about how we think about risk management from our perspective, and as an institution also, that's also very important to drive home the point that you're looking at risk from a decomposed manner rather than just looking at outright yield, outright returns. So as we think about that, what kind of risk you're putting on, what kind of risk you're taking out, I'm seeing that kind of growth in terms of thinking about cross-assets hedging.
It's testament to everybody in this room. The difference in your risk management postures from what happened, very much triggered by FTX, is remarkable. Everyone's kind of adopted a lot of what's been in existence in TradFi for a very long time. When we started 6 years ago with some of the first risks we ever saw, good risk management was 2 people signing a transaction rather than 1. Now, lots of people are actually making decisions as to whether or not they do this, whether or not they go into this derivative, whether or not they are going into this new kind of structured product. And, it's actually impacting the decisions that are made rather than just looking at absolute profit and where is my 100x. I'll take the 5x, please, and I'll take the 10x. And that's very frequent that everyone is having that conversation. And we see it because it's part of the information that we have to ask.
We have a few minutes left. Maybe we can just highlight some of the products or trends that you guys are excited about or looking forward to in the future in the crypto/institutional space.
Yeah, I can start. I mean, generally, like on one hand, basically just see this improved plumbing. Like, okay, not necessarily on chain. On chain will take a lot longer, but just see a lot more prime broker-like structures and basically uncentralized, basically connected to centralized platforms. Another thing that I'm personally more excited about, been excited about for a while, is basically see a wider breadth of products, specifically, for example, basket products, basket derivatives, that people in crypto don't seem to be very excited about yet, but I think they're just very good in terms of managing risk as well, like in terms of pair trading, in terms of, shorting a basket of cryptos, again, longing something that you are bullish about. That's just a lot safer bet than just being bullish on something.
Are they not excited because everything's so highly correlated? So like a best of put?
Much less now. And you can also construct more interesting baskets like, Solana ecosystems that would be quite uncorrelated to rest of crypto at times.
So I think the 3 key things that are sort of happening in this market cycle are the vast proliferation of stable coins. I think that's really interesting. Prediction markets are very, very compelling, and I think will long-term become an entire way to not only obviously predict outcomes, but become an asset class in the data themselves. I think the emergence of digital asset treasury companies has been particularly interesting as well, as Wall Street looks for other ways to basically protect purchasing power. But if we look into the horizon a little bit, it's impossible to not talk about the impact that AI will have in merging with both retail and institutional products. One of the things we concentrated on at blockchain.com this year was launching a privacy-focused AI that's well-trained in all things crypto, and you can test it out at askjune.ai. This will become basically a CFO product inside our retail offering for consumers, but also provide our institutional clients wide amounts of data. They can build custom portfolios and more with it. I think it's going to be a really interesting way for us to personalize features and products that really meet our client needs. And so very excited about those things heading into the next couple of years.
I throw in there, I've learned over the years that I am not smart enough to figure out what types of risks people actually will want to take. So I love the idea of Coinbase announcing this goal of being the everything exchange, because I think the more the more options, pardon the pun, that you provide to folks like Melvin and Evgeny, the more they're going to develop that Rube Goldberg device that makes them money. Now, they're all going to want cross-asset margining. They're not going to get as much as they want because that's just historically how it always goes. But they're going to figure out relationships that I think is impossible for us sitting here to just whiteboard out. And so when you start to, whether it's, and stables now, they proliferate stables that will allow all of that to flow seamlessly. But I want to see what happens if I give them a single platform with tokenized equities, prediction markets, futures, options, good term structure, because with enough Evgenys and enough Melvins like looking at my platform, like they will discover trades I couldn't possibly imagine.
I'm trying to build the WeChat of crypto.
Yeah. I mean, very successful. I wouldn't mind that. Yeah, of course. Yeah. 4 billion users. Yeah, of course. I want to be the WeChat of crypto.
So insurance is traditionally very reactionary, and we're trying to be very proactive. And one of the conversations we're having, or a load of outreach, is around curators. It's KYC'd liquidity pools. That is where we're getting a tremendous amount of outreach. So we're trying to figure out how we build insurance products around that, which I guess then bolsters the potential, wants of TradFi to come into DeFi, where they can look at full KYC, where they can look at protections, and insurance is a big part of that. So we're busy trying to figure that one out at the moment with a lot of our clients.
It's going to sound a bit pessimistic, but I think the market needs, or what I think an institution will really need is that we need to kind of make sure that the digital asset treasury companies, they operate well into the next 6-12 months. I think that's going to be a big confidence boost as we think about it. The first narrative has always been about accumulating the tokens. We'll come through a phase where MNAV is coming under a lot of pressure. And I think what needs to happen is that I think the digital asset treasury companies need to focus more about costs, about generating some form of revenues, and trying to create a sustainable way of accumulating. I think without which we could go into a bit of a crisis in terms of confidence. I think that's something that I feel that it's just a very small innovation, but if we can get that right, that'll be a very interesting journey.
Great. All right. Well, that wraps it up. Thank you very much, everybody. Please give a round of applause to our fellow panelists. Thank you.